and welcome to the Build and Exit podcast. I'm Julie Wilkinson. I'm looking forward today to sharing some insights into the financial world, financial skill sets that will really help you. So let's get straight into it. Now, I talk to entrepreneurs and business owners all the time. And one thing I hear a lot is, I've got that covered. I've got an accountant. I love my accountant. I trust them to save me loads of tax. Yet sometimes in the background, they're scrambling around for information. They don't trust data from the system. And ultimately, they are still getting involved in financial activities that's draining their time, their resources, and ultimately often costing them thousands of pounds in sort of hidden risks that they're not identifying. And I think this is happening from the fact that business owners don't actually know what a finance team can do. You know, I tend to find business owners that have come more from a corporate background, have a bit more hierarchy of scale knowledge, so they understand sort of different skill sets in finance. But you only know what you know, right? So today I'm going to break down 5 core skills that business owners really need to utilize if they're going to grow their business to the next level. My business, Wilkinson Accounting Solutions, we help business owners and entrepreneurs put in financial compliance, risk mitigation and governance. What it does is it ultimately protects shareholders' wealth, reduces non-compliance, and ultimately often 3x's the value of the business because it becomes an asset and tasks can run independent of key individuals. So let's get started. Here's my 5 key skills for business owners and entrepreneurs. So the first one is financial literacy. Now, I'm not talking financial jargon, debits and credits, although obviously for the accountants out there are listening, that's really important. But from a business owner's perspective, it's really about knowing your cash flow, your gross margins, your break-even point, and different key elements of your profit and loss and balance sheet that's really going to impact basically the success of the business. You know, we all hear the word cash is king as a terminology, or that's a common phrase that people say. And ultimately what it means is, you know, you can be very profitable on paper, but still run out of money. And generally, when businesses do go insolvent or run out of cash, it's not actually because the business isn't successful. It's purely because they've overtraded or they haven't had the right data to make the right decisions at the right time. And I've got hundreds of examples from acquisitions we've been involved with, through clients we've worked with, and just generally through the people I've interviewed on this podcast and all my surveys. I've surveyed over 200 business owners looking at financial compliance, financial literacy within the SME market. So what does it mean? So an example for you, I was once looking at a company. They had made about £150,000 of profit across a couple of years. And on paper, they were like, great. But what was happening, they didn't seem to have the money to pay their tax bill. And they never really knew why they didn't have the money to pay the tax bill. On paper, they were reporting this money and they never had the cash. So we did a financial audit. So we do financial compliance audits where we investigate these types of discrepancies. And ultimately, it turned out that credit card expenses had never been processed. So they had about, I think in general, it was somewhere between 125,000 and 150,000 of expenses, obviously wiping out all the profit. And how that had built up is the credit card payments had gone out the bank and been posted. So the bank reconciled in the system. But actually, the other side of the transaction, which was the expenses get processed, had never been sent to anyone. That hadn't been processed. So it was sitting on the balance sheet as an accumulated balance. And ultimately, what that actually meant is their business didn't turn up have a net profit of 150,000. It actually was only just about break even, if not potentially in a loss position from a cash flow perspective. Now, that was 2 to 3 years of hard work. And imagine the feeling when you find out, oh my God, I haven't actually made any money. So this is where really having financial literacy is helping, because obviously I'm not taking away the fact that people have accountants and advisors. Obviously you should be utilizing them because they do a lot of the complex working that makes the balance sheets and the profit and loss be what they are. But no advisor is with you 24 hours a day, 7 days a week. And if you don't have any strategic finance team employed or with you on an ongoing basis, and you have to make these decisions, then it is important that, one, you can get the data from the system, and 2, that when you get that data, you can understand it. So that is financial literacy. Then we look at forecasting and scenario planning. I hear a lot from business owners, and being an entrepreneur myself, running my own business, I've done my own acquisition. It is hard as a not just an SME business, any business, even in corporate business where I used to work in them, it was hard to forecast. Every business is unpredictable and there's turmoil in every industry. Ultimately, in my opinion, forecasting isn't just about forecasting a vision, it's about forecasting the risk. The reason for that is because the biggest risks to your business is what can close your business overnight. That's why we've seen corporate businesses go, fail over years. Yes, it's partly through diversification and not staying in touch with the market, but a lot of the times it's also down to poor working capital management, over trading, and high overhead costs. That's ultimately landed to a cash flow position because the business ultimately generally ceases trading because of the cash flow. There are other reasons that make the cash flow become insolvent, make the business become insolvent, but ultimately it's the running out of money that makes the business stop because they can't pay their overheads and they can't pay their staff, so they don't have a business model. So when we look at forecasting, I definitely agree. Entrepreneurs should have 5-year visions because I believe I'm quite a spiritual person. I believe in manifestation. And I do think that is how you drive sort of personal success and what you put out to the universe. However, forecasting on paper, to me, is about risk mitigation. Yes, you'll have that. I want my sales. I want this gross profit. But the truth of it is that can be versatile. Things could happen in the market. Things could happen quickly in the market. So what you forecasted 2 months ago may not be valid now. And you have to be able to adapt those forecasts and change them quickly. But biggest risks, hidden risks, are things that maybe don't happen very often, but likely could happen. And if they did happen, it could have severe consequences to the business model. So this would be things like, if we just look at what happened in COVID. Now, a lot of business owners will say, or I'd say, the people I survey, 75% have said, well, we never knew COVID was going to happen. We couldn't predict it. But what actually was, COVID wasn't obviously a very distressing time, and we all got locked down and we couldn't open buildings. But actually, if we look at it from a financial modelling perspective, it ultimately was trade dropped. Trade either ceased trading. Some businesses did just stop trading. Some actually grew through diversification, and some carried on trading and got the furlough grants. Ultimately, there was kind of 3 key scenarios, and that all had a financial impact on the business. Now, our survey show that people that forecasted scenarios, so they may not have known COVID was going to happen, but those that had scenario planned. So, for example, before COVID hit, they had their forecasts and they said, what would happen if my sales dropped by 50%? What would happen if my sales dropped by 25%? What would happen if my sales completely dropped? Or even if you didn't go as far as complete drop, because you may have found that never happened. You can work out what's known as a margin of safety. And a margin of safety is ultimately what is the lowest, my sales and my business can drop before I'm at risk of insolvency. Now, those businesses that had that forecast, it didn't stop COVID happening. It didn't stop the challenge. But what it did was it meant the day it hit, within 2 or 3 weeks, they knew how to resolve it. Or if they didn't have a diversification plan, they knew how to mitigate their overheads or to protect their cash so that they could get through it, so that they could then trade on the other side of it. But either way, whichever way it was, obviously different businesses are different. Those that had forecasts could implement scenarios relatively quickly. Those that didn't have anything and had never forecasted or had any real knowledge because they were just kind of trading cash accounting from the bank, sometimes it could take 6 to 9 months to even get anything like that if you're not prepared for it. And those businesses were definitely are at risk. If not, a lot of them did fail or had to close or start again after COVID. So to summarize forecast and scenario planning, yes, forecast your sales, you want your growth, you know what you want from your wealth, but ultimately forecasting can also be used to mitigate biggest risks. What can close your business overnight? What would happen if this happened? And that is what we use forecast and scenario planning for. So then we look at data interpretation and storytelling. So what does this really mean? When I used to work in corporate, we'd spend weeks on forecasting. They'd have 50, 20 pages of board reports. And the truth of it all is it's all a bit overkill. In my opinion, businesses need to know key numbers and they need to be able to tell stories against those numbers. When our business, when we see people trying to exit the business and they don't get what they want from it, some of it is the valuation and some of it is the past trade, but actually a lot of it is the interpretation and the story that goes behind the numbers. So we see things like people running poor month ends, so that don't run good bookkeeping practices, have fluctuating monthly movement. So one month their gross margins are 75%, the next month they're 15%, the next month they're 35%. So then when you say, yes, you may have a year-to-date margin, so you may run your financial accounts of companies' house, that might be what your accountant does, and you have a year-to-date, and perhaps even that year-to-date is where you expect the business to be. However, the challenge will be any business that's running risk-free or ready to sort of run independently of key individuals should be able to access that data from systems, from different people that want to run it, have a finance team that can interpret it, and ultimately within sort of, somewhere between 3 to 5, maybe 10 days at most, at a month then be able to get access to that data. Because the truth is, if you don't get access to the bookkeeping and the balance sheet, you can't really trust your cash flows right because you haven't got your working capital cycle. So then we look, so when we look at their monthly margins and these margins are skewing, what's actually happening is it's causing distrust in the numbers, because my observations and interactions with clients and looking at acquisitions and exit plan and people that are selling, you'll say to a business owner, well, why did you have a 65% margin in January and it's a 25% gross margin in February? And they can't answer the question. That is storytelling. Storytelling is, I had sales, I had costs, I had a margin, I had cash in the bank. But why, if you are running a business model that makes money, why would it not be a consistent margin each month? Now, there could be genuine reasons. Obviously, people are seasonal. They could have times of the month where they did have poor trade, but costs go in line with variable costs in cost of sales and gross margin go in line with sales typically, if they're not fixed costs, which is why you have sales and gross margin, because that's the margin generated from the sale, which is generally variable costs, not fixed costs. So if you can't get your profit and loss, look at your monthly numbers and articulate those numbers into a story, then it's hard when you get to the sale process, because it's that story that the investor's going to want to see when they're buying it. Now, interpretation of financial literacy, what we talked about earlier, comes into this, because the P&L, profit and loss, is only as good as the balance sheet. So an example of this, we went into a business once that after it had been acquired, normally we get approached because people are like, our cash flow doesn't make sense. It doesn't seem to be where it should be. Our profits never seem to close where we think. We know we made money, but we're not showing it in our accounts or in our cash. And that's generally being driven by the numbers were wrong, or the data was corrupt because there was poor bookkeeping behind the back of it. An example of that, when we went into this business after it had been acquired, we did balance sheet integrity. So we looked at did the financial have good integrity, and we actually found one of the companies we worked for, a 750,000 discrepancy on invoice financing. What that meant was their balance sheet liability that was on the balance sheet, so that's ultimately what the system is saying you owe as the liability, was £750,000 lower than when you went into the invoice financing system. So you got a statement from them and they told you what they owed, £750,000 lower. So that means if that number doesn't match, there's a fundamental, at that materiality, there's a fundamental integrity issue, which means you can't trust the P&L. Because if you've got a 750,000 discrepancy on the balance sheet, you've got a discrepancy on the P&L, which means ultimately the original valuation is probably wrong, overstated or understated. Obviously, in this case, the liability was understated. It can be in different ways. But that then means, what's the integrity of all the other financials? Because if that's just one number and one type of transaction, what's happening on the rest of the balance sheets? So data interpretation and storytelling is really important. And what it basically means, can you articulate as a business owner what is happening with your financials Because you may think now, oh, I don't really need to know. I know my business is profitable. It gives me what I want. I earn the money I want. And that's fine. There's nothing wrong with that. But if in the end, you don't want to work all the hours and you want somebody else to invest in it, or you want to grow it and it runs without you, then other people have to be able to articulate that business. So if a third party couldn't come and look at your data and help you interpret it, then it means it's very reliant on one person to interpret it, which then gives you a similar sort of risk. So then look at digital finance and automation. I've actually been posting a lot about this, especially in AI and tech. So tech's been around forever, and there's good tech out there now, and there's no doubt about it. AI leverage is massive. I mean, we're utilizing it for our clients. Just the other week, we saved about 12 hours on one task a month by utilizing tech and AI more. Some of it is use of AI. Some of it is just helping people use technology in general better. Now, finance and automation is really, really critical because it does a couple of things. It reduces risk. When we look at compliance and risk mitigation, we look at the best and foremost is stop risks from happening. That's the most practical. If you can literally stop a system from letting anybody doing something wrong, that's best practice. That's all singing, all dancing. But that can be very expensive because you can need really detailed systems to do that. Second best practice is if you can't physically stop the system from making an error, then you put in some form of manual check on top of it. So there are then checks at integral parts of the process that you can check to make sure that those processes aren't falling down. To do that, we would recommend having different people at different stages in the process. That's known as something called segregation of duties. So segregation of duties is effectively giving people different access to different parts of the system so that one person can't do everything. And the reason for that is partly fraud, because when one person can do lots, they have, there's a high reliance on them, but also there is high risk that they could do something. And then even if they didn't do fraud, there's high risk they can make an error. Now, we don't want to you don't want lots and lots of checks every single time in every single process, because then it's overkill and it's not efficient. But it's about understanding the key risks of a process and making sure you have sensible checks across integral parts of the process. So if we take something like a sales process, for instance, so when we do our compliance audits, we go in and audit purchasing, sales, cash flow, balance sheet integrity. We have different areas of the business that we will look at. So if we took sales as an example, key integral issues we see in automation is things like people have different systems. So they'll have a project management system, which is sometimes a CRM, or sometimes it's a more detailed project management tool. Or it could even be a bit more of a complicated ERP system where it's also got a finance tool within it. But either way, we find businesses are often running dashboards from front-end systems. We find front-end systems, and front-end systems mean CRM tools, dashboards, often what's customer-facing, so what goes to the customer. We call back-end systems technical systems, like accounting software, where they typically are for internal purposes or external, if you use obviously external accountants and things, but for financial purposes more than reporting purposes, because we find front-end systems typically have better reporting than back-end systems, because back-end systems functionality is for transacting and accurate reporting, whereas front-end systems give visual representations quite nicely through dashboards. That's kind of like the difference in systems. So when you have different systems, those systems integrate. And there's different ways those systems can integrate. They can integrate manually. So you process in this one and then you process in this one. That's obviously very time consuming, high risk, because you're getting one person to do something twice, and costly. But it's where a lot of people start. It is where people start. Second, a development from that would be sort of some form of automation integration, but maybe not full integration. So that would mean third-party system exports a report that gets imported into a second system. Now that's one, speeds the process up because you're not physically processing in both systems. It often reduces risk because it means you only put the data in once. So it will reduce risk because someone isn't having to type it twice and you import the data. But ultimately it can still crash. Something can still go wrong. And then the third, and all singing, all dancing, is full integration. That can be very expensive and can require IT for constant development. I mean, I remember our corporates used to use Sage, but they had 50 IT people who, because they'd bespoke the system so much, because they had to, the off-the-shelf system didn't do what they wanted. So they had to sort of build other sorts of integrations that then tech people had to manage. Now, bigger firms might do that, but smaller SMEs, you've got to then sort of look at cost versus reward. So the cost of running something versus the reward of what you get from it. So most people start in the manual section because they don't have the integration, because they basically just buy the systems, have the platforms, and then don't know what to do with them. So if we go back to the sales audit, what we find typically is the key risks is things will not integrate from the CR, the front end system, into the accounting system. So an example of that is we did a sales audit on a system. They had a front end, they had zero, and we did an audit on a few months worth of data, and we found that at 85 grand sales hadn't been raised to the customer. So the integration risk was the operational team were using the project system, closing projects as they did it, but somehow that information had to get over to finance. And what actually was happening is, in this scenario, which is quite common, was it was part working because they were meant to update categories in the system to say when the project's finished. The truth is most people didn't update the project system. The owner was going in ad hoc, finding the problems, fixing the problem, raising the sales invoice, and ultimately this one or two just got missed. They closed it, they didn't notice it, and it didn't get raised. And that was like about 85 grand. Now, that didn't need all singing, all dancing automation necessarily. Yes, it might speed the process up and reduce the risk. But what it did need, so what the solution was, to put it a quick win, was, well, how do you get reporting how do you do integrity checks from the operational system into the accounting system? Now, the owner could go, well, I could do that. I'm doing that. Well, they didn't do that. And it wouldn't be sensible. It doesn't matter whether it's the owner, whether it's the finance, whether it's the operational person. It's never sensible for the same person to do the input and then do the check. Generally, what I mean by that is, if you're in charge of the operational system, you wouldn't want that operational person to then check the finance system, because if they've done it in the operational, they're likely to miss it in the finance system. So that's where you would segregate the activity, and we would be expecting a finance person to put it into the finance system and do the reconciliation, because that's their skill set. They've got skill set on numbers, they've got skill set on Excel, skill set on financial systems, and can do those reconciliations, and then they can provide the output. We have then since helped businesses improve those even further, even just by the use of AI, which hasn't meant you need to fully integrate, but you can utilize faster ways of reconciliations before you move to full integration. Because the risk is you move to full integration, you haven't sorted the issues. Because even if the system interlinked, even if that system automatically posted the sales, it doesn't stop the operational person not raising the invoice, saying you need to raise the invoice. So if it didn't tell the system to raise the invoice, the automation wouldn't raise the invoice. And just because you've got one side, if you haven't got the integrity report, it's not going to tell it. And then the final thing of my 5 tips is commercial and strategic thinking. So this kind of just wraps up everything I've sort of said earlier. It's how do you strategically use finance to grow the business? Now, this is just things like knowing, or in the marketplace, what's average margins in my industry. There's so many business owners or entrepreneurs that don't actually know that. They don't know what good looks like. So they don't go and invest. They don't go and research other industries. Maybe you could be better than other industries. Great. But, for example, service-based businesses typically can run at 35% net margin. And when it comes to commercial understanding, she's thinking, understanding the difference between gross margin and net margin and EBITDA. Just having understanding those terminologies, because they are important. Maybe they don't seem important to a business owner day to day when they're just looking at their bank account and they're looking how much sales. And I'm sure most people do look at their net profit, but it's whether they understand their net profit and does it make sense. Because like I said, if your gross profit is fluctuating every month, so is your net profit. So it's one thing having it, is another thing understanding it, is a third thing to then strategically use it. So in finance, we say, looking backward. So if you go backwards, you can go forward. So we use past information to drive forward data. So a lot of people say, yeah, but you don't want to spend a lot of time with the past. And I get it. I'm not talking about spending weeks and weeks and weeks and weeks analyzing past data. However, how do you ever know if something works if you never look at the past? So meaning, so many people are running their commercial meetings and they're bored of using these front-end dashboards, yet their financial system, which is actually where the bank account links and where the financial data is presented, doesn't link back to the project management system. So one system saying, oh, we make 45% margin, but actually that doesn't account for the fact when suppliers overcharge, when people haven't raised purchase orders, when you've got expenses, where people are buying stock on expenses or credit cards and it's not going into the purchase order. That goes into the finance system because that gets transacted through the bookkeeping. So commercial and strategic thinking is about understanding the bigger picture. It's about looking at what are my biggest risks? Where am I at risk financially? So not just growth of sales. Obviously, growth of sales and business growth is important, but actually you can grow too quick if your operations can't cope. So going back to that sales scenario that I said, where that 85,000 didn't get invoiced. Now, perhaps the 185 grand doesn't collapse the business. But actually, if you grew, so if you tripled the business but never sorted the system, and that 85 grand tripled and started to turn into 300,000, 400,000, 500,000, at what point would that then cause you a real big cash flow risk? And how long would it take to find that issue should you get a lot bigger? Because issues are harder to solve as you get bigger, because there's more data, more people, more operational bottlenecks than there is when you're smaller. So I often get people say, oh, we're not big enough for that. I don't need a CFO yet. I don't need reporting. My opinion, every single business owner needs reporting. That reporting is facts. It tells you the truth. The question then is, can you get the data quickly and can you trust it and can you use it? So, when you're looking at your pricings and your margins, it's not always just about what cost price am I paying and what am I selling it at. There are hidden things underneath the processes, like accurate transacting, like operational processes, like accuracy of systems and data, because all of those outputs might not necessarily drive the sale, but what they do drive is the integrity of the data. That is what you use for decision making. And ultimately, your strategy. So your strategic thinking are your business strategies. So there you have it. There's the 5 skill sets that every SME business needs to have a back office function, start seeing opportunities, reduce your risk, and ultimately increase the value. Because out of all the businesses we've audited and we've researched, we found every business had a minimum of a 10% risk somewhere within an operational bottleneck where they're leaking cash without even knowing it because they don't know what their systems can't produce without having some form of risk management in place. So thanks for listening. I hope you enjoyed the episode. If you think other people can really benefit from this, from the podcast, do share it. Share it with your other SME businesses. Share it with your friends and family. The message is out there. An entrepreneur doesn't have to do any financial activities in their business. The business can run independently of an owner, and the business can run with smooth financials and data. It just requires implementation and a compliance framework put in place where it can run. So there's my last thoughts of the day. If you like the episode, hit the subscribe button, and I look forward to seeing you soon.